Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help people get better returns in the stock market. I'm excited today to be talking to Jesse Myers from Onramp Bitcoin. Um, they are doing some really innovative things in the area of Bitcoin custody, and today is their launch day. Jesse, thanks for being with us.
Thanks for having me, Gary, and especially today.
Yeah. All right. So I would love to actually get to a conversation about what you guys are doing at OnRamp Bitcoin, because I think the issue of self-custody is really important. But before we do that, let's start with some of the basics, right? Because not everybody, is following Bitcoin. It's confusing. Let's just start with some of the real basics, right? Why Bitcoin as opposed to any of the thousands of other coins, and how does Bitcoin differ from crypto? Why does the Bitcoin community, in my opinion, correctly, but they distance themselves from crypto? They say there's crypto and there's Bitcoin and they're not the same. Why is that?
Yeah, absolutely. So, I think there's a couple assertions that have to be made here. And one is that the first is that gold is a valuable asset, right? So it's actually not even about, to begin, it's actually not even about crypto. It's about hard assets, right? So gold is valuable because it's scarce, because it's hard to make more of, and because humanity has converged on gold as a store of value because of those properties. And then along comes Bitcoin, and is really a manifestation of digital gold. It is the invention of digital scarcity, and it has the properties of gold. It's scarcity perfected, really, because there's a finite amount of Bitcoin. There's only going to be 21 million of them. The amount that's mined every year gets cut in half every 4 years. So it actually has increasing scarcity, culminating in terminal absolute scarcity. And that makes it like gold, but it gets more and more scarce over time. So it's actually gold with a little jet fuel. And so that becomes a very interesting asset. And then you can look at, okay, why Bitcoin? Why not everything else out there? All the other cryptos. There's 30,000 other crypto projects, and the secret to understanding it is in how we already began here, that Bitcoin is the invention of digital scarcity. And why that's important is, on the internet before Bitcoin, it was never possible to have something scarce, because the internet is just information. You can copy and paste information endlessly. And Bitcoin was the invention of a system where within that system, it was impossible to copy and paste the units in that system. So a Bitcoin is impossible to copy and paste because it's a decentralized ledger, and that's the way that is maintained. But the thing is it's possible to copy the entire system. So all these other crypto coins, starting with like Litecoin, which is really just a clone of Bitcoin that was called Litecoin, but then also including Ethereum and 30,000 other projects. They are copies of a system of digital scarcity, but the marginal cost of creating an additional system is nothing. You can copy and paste an additional system of digital scarcity. And so that means that what we've seen accumulate over the last 15 years is there's Bitcoin, the invention of digital scarcity, and then there's 30,000 other copy pastes of that and counting. So those systems don't have scarcity because you can always spin up a new one. And I think that's the philosophical core of why Bitcoin is different from crypto. The other half of it is that Bitcoin was designed to be a commodity, and it developed this network effect by bootstrapping for several years as the only player in town. And then along come these other crypto projects that needed to catch up, and so they implemented a system of retaining some of the supply for themselves as like a war chest. and that war chest is directed by a leadership team. So basically, you have a company now. You're talking about something that flies afoul of the Howey test. And so that's what we see out there in the broader crypto landscape. There's Bitcoin, this commodity that nobody controls. Nobody retains any portion of that supply. It was set into the wild on day zero and just released. And in fact, the creator of it stepped back, into the shadows. Didn't want to be a leader because that individual knew that the only way this thing could work is if it was truly decentralized and there was no authority to clamp down on, because it had to be a commodity. And then everything else is a security masquerading as a commodity. Gary Gensler has described these as dinos, decentralized in name only. And the SEC has said quite specifically that Bitcoin is a commodity and everything else is not. And that's as far as they've gotten to date in terms of their language. But it's clear that, as time goes on, Bitcoin's the only one that's safe and only one that people should be, in my opinion, touching.
Yeah, I think the key issue that you brought up, actually, everything you said, they're all important topics, but one of them that I really like is the idea of the inability to copy and paste. I supported a friend of mine who did, he did an illustrated book, almost like a Kickstarter kind of thing. And so, I bought the digital book online and it was emailed to me. But when I went to check out, there was an error in it. And, you could subscribe for 2 copies or 3 copies or 4 copies. And I'm laughing through the whole thing because you get a PDF, you get a digital document, right? Now, in this case, is a friend of mine and I respect his intellectual property and I will keep the document private, but there is nothing that would have stopped me from emailing it to 1,000 other people. They would have all been perfect, exact copies. And, with Bitcoin, you simply can't do that. But I really want to get you to answer a key question. So many people ask me the question, well, how do you know there would just be 21 million? Right? Why can't there be more? Right. And it's not a dumb question. If people like us are saying one of the advantages of Bitcoin is its scarcity, right? 21 million, that is the sum total that will ever be mined. And where are we now? Just about 19.5 million or so?
Yeah, that's right.
Okay. And so, for everyone listening to this, total of 21 million, we're at 19.5 right now, probably 3, 4, 5 million have been lost irretrievably. And the other 1.5 million we mined over the next 150 years or so. So, but Jesse, people ask me all the time, well, how do you know there won't be 21 million? Why can't they change it? Right? Like the US dollar. Why can't they just print another million? Or in the case of the dollar, another trillion? So why can't they do it?
Yeah, it's a beautiful orchestration of incentives that prevents that from happening. And it's kind of hard to describe with any silver bullet explanation, but we can approximate it with a few different things.
That's okay. You know what, Jesse? This is not like, you don't have to do a white paper here.
Yeah.
A simple, clear answer for a video is great.
Absolutely. So what we're talking about here is a protocol standard. That is what Bitcoin is, and that is the same as like TCP/IP or HTTP or the World Wide Web, right? So when you want to go to a website, you use the World Wide Web. And if you're a company, you don't have to put your website on the World Wide Web, but you want to because that's what everybody uses. And so abstracting it further, like, why do we only have 7 days in a week? Let's add an 8th. That's ultimately what the same question of like, why don't we add an additional day to the week? It's because it's a standard that everybody's agreed upon, that there's 7 days in a week, and changing it amounts to what's called in Bitcoin a hard fork. You can change the rules, but you have to convince everyone to join you, or you have to convince a sizable group to join you, and then you've splintered the the world into two groups: the people that stay with the old rules and the people that split off with the hard fork and the new rules. And so, we could have that with the day of the week, right? We could have some splinter faction that decides that there's an 8th day of the week and it's called Gary Day. And then we'd be living in a world where we'll see how many people subscribe to Gary Day, that comes after Sunday, and how many stick with the old way because, it's a protocol standard that everybody's aligned on.
I also think, one of the key things that you talked about earlier is incentives, right? So, one of the reasons why people want to own Bitcoin is because of the hard cap of 21 million. And so, here's the thing, your Gary Day example, I love that example, of course, but, it also would depend how you marketed it to people. Like, what if you said to people, we're going to add an 8th day of the week, and on that day, everyone's going to work 16 hours, 20 hours, right? Everyone has to be up. You're going to be at your desk working for 20 hours at your job. I think that would get very little support, next to no support from, other than me. I'd be in favor of it. But, what if we said, okay, well, this extra day is, is going to be a day of rest and fun, and everyone's going to go to amusement parks and concerts and eat candy. And that might get, more support. And so one of the reasons people own Bitcoin is because it's limited. So who in the world, if you own Bitcoin, who in the world is saying, yes, please dilute me, please at no benefit to me, issue another 10 million Bitcoin and dilute the value that I have and make everybody not trust it. The people who own it have no incentive to go along with a scheme like that. Their incentive is to keep the existing structure in place in perpetuity.
Exactly. Yeah. It's Gary Day, but you have to work for 20 hours that day. So who's going to sign up for that?
Yeah, I might be in favor of it, but it's not going to be well regarded. Jesse, the other reason you gave is centralized control. And I think that's a key one. When people ask me what I think of Ethereum, my answer is always, it's great technology. There's a terrific use case for it, but there's a centralized control issue. And with Bitcoin, there isn't. Now, when you and I have this conversation, we can speak in shorthand like that. But let's take a step back, right? Let's now talk to an audience of people who, like, they've heard these terms, but don't really understand it. And let's explain to them why centralized control or decentralization matters, and why Bitcoin falls in one camp and why other crypto falls in the other camp. Let's unravel that for people and make it easy.
Yeah. So, I think it's helpful to think about how could you kill Bitcoin? How could you try to kill Bitcoin? Well, there's actually been a long history of attempted digital currencies, 40 years of people developing and trying different approaches, and they all failed for various reasons. The ones that did well got shut down because there was a centralized entity that authorities could shut down. And those shutdowns would happen within a year or two of a new digital currency starting to go somewhere. And so Satoshi, the creator of Bitcoin, was very aware of that fact and deliberately said that, I hope everybody understands that the reason these other ones failed is the centralized nature of these systems. So he was very deliberately going for a decentralized system that how do you stop it? What head do you cut off? There is no head to cut off. It's a protocol standard. Like, how do you change the days of the week? There's no authority that says this is how many days in a week there are. It's a standard that has become accepted. And it's completely decentralized in that way, right? Like, it is just a universal decentralized protocol that we all live by. And so that's a picture of Bitcoin. But then if you were to think about Ethereum, by contrast, there is an Ethereum Foundation that Ethereum, when it was started, they kept at the time 70% of the supply of Ethereum. A lot has been added since then. But a small group of people kept 70% of the supply for themselves and to fund development of Ethereum. And so it was like a small group of kings that are still the kings of Ethereum and still exert control. And all changes that happen on Ethereum, Ethereum has the sort of ethos of the internet of move fast and break things, which worked, in the .com era and the 15 years that followed. And so that's kind of the Ethereum culture is move fast and break things. And they're trying to apply that to money, which is sort of a funny concept in my mind, because money doesn't like to move fast and break things. It wants to be rock solid and unchanging, absolutely immutable, because if it's immutable, then you can trust it to not change in the future. The fact of the matter with Ethereum is they keep changing it. They keep changing how much the monetary policy of Ethereum, how much Ethereum is issued. And those changes can extend to, if a government wanted to have certain changes implemented, that would be doable because there's a centralized entity that government can go to and demand these changes through, in back rooms and back channeling. And that may have already happened. I happen to believe that's already part of Ethereum, and part of Ethereum's success is that it's a controllable alternative to Bitcoin, and therefore friendlier to governments. And so I think that's been part of its tailwind to date. But that paints the picture of there's one here that is changeable and controllable and stoppable, and there's one that is not.
Yeah, I think you touched on two key points here. One is when Bitcoin was founded, the story as I've heard it is nobody granted themselves coins.
Correct.
They started mining. But it's very different for something like Ethereum or other crypto where, people pre-mine or they just award themselves something. And, it's something that we see in equity offerings, but that's very different because, you have the owners of the company doing something with it. Regarding control, one of the things that I think is really interesting, people always talk about some sort of, government's ability to control. One of the things I say is, no, the governments can't control it. So, well, they could outlaw it. You can disconnect from the network. You can tell your citizens that they can't use it, but they can't shut it down. And the best example of that was 2 years ago, China outlawed Bitcoin mining. The network didn't hiccup. The servers got packed up, shipped to places that had, hydroelectric power or intermittent power, and turned on. And they just started mining again, right? In other words, even the Chinese government, which has maybe more control of their people than anyone anywhere, except for, say, North Korea, they were unable to stop it or even slow it.
Yeah, that's such an important point, that the super sovereign nature of Bitcoin provides it a degree of resilience that is remarkable. And in the China example, that it is as perfect of an attempt to stop Bitcoin by a singular government as we've ever had. And I don't think they could execute it much better than any country could execute it much better than that. They effectively, without much warning, shut down the industry in the largest mining industry nation, Bitcoin mining nation at the time. And like you said, the incentives there were to ship those pieces of hardware to somewhere where it was allowed and there was energy to make a profit by plugging back in. What's also funny about it is that to this day, a significant portion of Bitcoin mining we can see on the network is still coming from China, which is to say that there is illegal mining operations that are still skirting the authorities in China because there's still incentive for them to participate in this global network and make money by contributing energy and hardware power, despite the fact that it's illegal there. It's that unstoppable that even though China banned it, Bitcoin's still alive in China.
Yeah, that's a great point. So Jesse, I have some other key questions for you, but we just got a phenomenal question from Ramiro on the call here. And it is part Bitcoin, part economics, part philosophy. It's a really interesting question. And it's good enough that I'm putting my questions aside. I want to read this to you and let's think this through together, because it's one of the best questions I've ever seen on one of our calls. Ramiro asks, I struggle to understand the intrinsic value of digital currency. Being capped, is it supposed to represent the value of goods in the world? If so, how is it fair that people who bet on it before it runs out would own most certain digital currency and thus most wealth in the world? Am I missing something? He's asking a really interesting question on what does Bitcoin represent? And is there an inequality question where rather than, and there are plenty of people on this call who are not Americans, but though people are here because they're capitalists. And we have the sense that money should follow hard work, effort, intelligence, ideas. And, he's saying, wait a minute, what, are we just going to have massive inequality because we'll have a few early adopters who happen to grab the right digital currency as opposed to the other? I think it's a really interesting question. I'd love to get your response on it.
Yeah, it's a great question. And Ramiro, this was one of probably my last big hang up as I was going down the proverbial Bitcoin rabbit hole. It felt like this would just cement wealth inequality forever. And I didn't see how that would make a better world. But the answer to that for me actually lay in the past of, so I live in Los Angeles, and I happened to go to a friend's wedding at his old family ranch. And in doing that, I learned a little bit more about the history of the area and the history of how ranches were done in California. So 150 years ago, when Mexico had to distribute ownership of land in California some way, and so they implemented the rancho system, where they parceled out 10,000-acre ranches to whoever was going to be a loyal steward and support the Mexican government and take care of the land, and bring law and order to that piece of land. And so there were 10,000-acre ranches in Southern California. And fast forward to today, how many 10,000-acre ranches are there in the LA area? There's none. There's none anymore. And the reason for that is because the wealth was distributed over time, because those early adopters of Western real estate, of California real estate, saw the value of their land grow. They became wealthy. They had kids, and those kids had kids. And the ranches were parceled off, and then those parcels were sold to developers to, cement, to transfer some of the wealth that the family had established in real estate and diversify into other assets and fund a wealthy lifestyle. And that was the story of what happened to every 10,000-acre ranch in Southern California. And now there are none. Now you're lucky if you find a quarter-acre parcel in Los Angeles. So I think that story is the story of what happens to early adopters of a nascent store of value asset. They're early, they get a big chunk of land. It's the story of the Oregon Trail as well. The Oregon Trail happened because Oregon was brand new, not even state at that point, said anyone who makes it to Oregon will give you and your wife 640 acres for free of fertile farmland. You just have to get here. And that's why the Oregon Trail happened. And of course, that happened for about a decade, and then not anymore, because those early adopters got all the land and then started parceling it off over time. Anyway, so I think that historical analog analog of what happened to Western real estate, American West real estate, is the key to understanding how, when a new store of value asset becomes valuable, that wealth is eventually distributed because of the inevitable realities of life. You want to diversify, you want to live a wealthy lifestyle, your consumption increases, your children and their children distribute that wealth similarly. And so, what we've actually seen over 15 years in Bitcoin is the size of the wallets on the Bitcoin network, the amount of very large wallets has been slowly decreasing. Well, not so slowly, decreasing every year, which is to say that people who used to have 10,000 Bitcoin sold some of it. Maybe they sold 25% of it to, buy some real estate or, buy a yacht, and they're living a lavish lifestyle and spending their Bitcoin. And that Bitcoin ends up somewhere else. And that Bitcoin ends up with somebody who today doesn't have any Bitcoin, but next week realizes they should own some Bitcoin and starts buying some.
I think that's a great answer. Just on a slightly side topic, if you're going to mention the Oregon Trail, just as a courtesy for everyone on this call who's over the age of 40, I'm just going to mention that you may have died of dysentery. So that was the game, right?
Yep.
You'd make your trip from the East Coast to Oregon in the game, and like your horse would die. You died of dysentery. You were shot by an arrow. It was a whole mess. Anyway, we apparently, Jesse, this is great. We have a bunch of economic philosophers on this one. Great follow-up from David. You ready for this one? Again, these are more philosophy questions than economics. Is phenomenal. David wants to know, he says, there's a huge difference between gold and Bitcoin. Gold has intrinsic value as a metal, including jewelry and electronics. Bitcoin has no intrinsic value. It's all based on what others feel it's worth. In addition, to actually use it as currency, it has to be converted into dollars for most use, or, in other places, let's just say converted into fiat. So he wants to know, why does Bitcoin have any value? This is a great question.
Yeah, it's fantastic. And it really is at the heart of it all. And since we're doing philosophical, I'll go with my more philosophical version of the answer for this. And this one is even more out there. So brace yourselves. It's a funny answer because how long have humans been using money? There's actually evidence that that shell money was being used at cave sites 70,000 years ago, and the shell money was only found in Homo sapiens sapiens cave sites, but not at Homo sapien neanderthalensis cave sites. At the same time, the population density that we see evidence of at those two cave site, two different cave site types, is 10 times higher for humans, for us, versus Neanderthals. And the suggestion is that, and we also see no real difference actually in like tool use or other sophistication. And so the suggestion becomes that maybe the difference between the two is the use of money, having the capacity to appreciate money might have been the species level difference and advantage of humanity over Neanderthals, which is a wild supposition. And if that's true, if you follow that forward, it is to say that the advantage that humanity has, the thing that the kernel, the seed at the heart of civilization, is a capacity for appreciating scarcity and valuing that in an item, such that you can have the emergent properties of money come out of that, such that I think that your cool little shells are scarce and I covet them, and I'm willing to trade goods so that I can have those shells. And then I start to realize that, as our social group starts to conduct trade based in units of shells. and then you have trade and you have an economy. And it may be that Neanderthals, that was the gap between us and Neanderthals. So that's all to say that at the heart of humanity is an appreciation for scarcity, which it allows for money to the properties of money to occur. What we then see after, starting 70,000 years ago and then playing forward is different types of commodity money being used by different groups all over the world. And that it sort of plays out like a March Madness bracket, in terms of when a civilization comes into contact with another civilization and they have two different types of money that they use. Some use shells. Another group has moved on to value salt, and then those two civilizations come back into contact with each other and conduct trade. And the money that emerges from that as the victor is the one that's harder to make more of, because the other civilization just makes more of the money that's easy to make more of and confiscates all the wealth by going and drying up a bunch of salt water. Here's a bunch of salt. I'll take all your land. Thank you very much. And so that process played out not just with shells and salt, but with cloth, glass beads, and then we get to monetary metals. Once there's enough civilization to support mining efforts, and it's harder to make silver than it is a glass bead. So that is a harder form of money to make more of. That's harder money, but it's much harder to make gold than any other viable commodity out there that could be used as a money. And so gold emerged over the last 6,000 years as the final victor in the physical commodity realm of this becomes money. It takes over the entire world, because every other civilization that wasn't using gold had their wealth confiscated from them by people that used a harder money than them. And so that's the story of money. It's been a physical commodity story up until the last 100 years, when fiat money has really taken over, particularly since 1971. And Bitcoin is a return to that heritage of scarce commodity money, specifically taking the advantages of gold that it's hard to make more of, and taking that to the extreme where it's impossible to make more of than the finite 21 million cap, which is really 2.1 quadrillion units, satoshis, sats, which are the cents to the dollar, in the Bitcoin world. So there's plenty of supply there, 2.1 quadrillion supply. It's not actually the 21 million that feels like that's not enough to make a workable currency out of. Anyway, all that to say that it's Bitcoin is the true heritage of money as a commodity, specifically because it is scarce, and humanity values that which is scarce, and that which is scarce is a better store of value over time, because it's harder to make more of, and therefore it's a better protector of your wealth, and it's harder for anyone to confiscate your wealth when you're holding a harder money. And so I think we're just seeing a natural, and I think this century will be a story of the natural gravitation of value into Bitcoin, because it's a better store of value, a more reliable, safer propagator of your value through time without dilution.
Yeah, and I also think it's worth pointing out, to add to what you're saying, that these things do shift over time based on relative scarcity and value. So two great examples. If we go back a few thousand years, peppercorn used to trade at a higher price per unit of weight than gold did. And, it's because gold only had so much use, but if you were eating the same bland food every day, being able to add some spice was a great luxury. And there was a point, Jesse, help me out on this, maybe 150 years ago, when aluminum, I think, traded comparable to gold. And then people found, oh, wait, it's actually not that hard to make aluminum, but it took some scientific effort to figure out how to separate and smelt aluminum. So these things do shift over time. The other thing that I'd add is, while David is 100% right that gold does have some industrial use, that is a tiny fraction of gold supply. And if if we were able to wave a magic wand and say, okay, everyone, gold is no longer money, and everyone say, okay, we agree, gold is no longer money, and all the central banks said, well, now we're guarding you know tons and tons of this stuff that we don't need. There just isn't enough industrial use to put that gold to work.
Yeah, I great point to bring up the other half of that question of I think it's actually a bit of a red herring that gold has value because there's utility, there's applications for gold in industrial processes.
You can make that argument for silver, but that has been a secondary money forever.
Yep. Right. Yeah. And a big part of the reason silver is a secondary money is it's actually, if the value of silver goes up, it becomes viable to mine a much greater proportion of deposits that are not economically viable otherwise. And so you see a massive influx of new supply to the silver market, and that squashes any rally that you see there. So with gold, there's some utility, there's some intrinsic value, there's beauty in it, and I think part of the Bitcoin argument is that those are accessories to the actual value of it, which is money, a monetary good, a good that can store your value over time, and store your value and propagate it through time specifically. And Bitcoin is a more pure version of that. It doesn't have the industrial applications or the jewelry aspect of it, but it is a harder form of money because it's finite. Whereas with gold, we're always mining more. And there's asteroids out there, and there's trillions of many trillions of gold dissolved in seawater, and all it's going to take is a technological breakthrough to unlock that supply. So and then there's the final point of Bitcoin links value in the digital world to real cost in the physical world because of Bitcoin mining. And so there is some argument here of, well, if a Bitcoin miner has to spend $20,000 to create a new Bitcoin, through the average of all their costs and energy expenses and what they get back, then the cost of production for a Bitcoin is $20,000 of energy and other expenses. And so there is that. I don't think it's the whole story, but it's a leg on the tripod of how Bitcoin has bootstrapped value, because not just because it is a perfect instance of this story of monetary scarcity, but also because there is an energy cost that is tied into the real world of the cost of production for a new unit of Bitcoin.
Yeah. So we've got two more really interesting questions in the chat here. One of them, Ramiro, has a great follow-up. He's asking, in principle, digital currency is poised to confiscate the wealth of those who don't adopt it. And then he phrased it as a question. And I think, Ramiro, the key thing here is it's not that one form of money confiscates the wealth of somebody else. It's that when your currency is hard, and hard simply means difficult to replicate, right? Like right now, the US dollar is very soft because the Federal Reserve or the Treasury, they can basically create more at the push of a keystroke. It's very easy to do. Gold is hard to mine. Bitcoin is difficult to mine. So the key thing is, when you have a valuable hard currency, you can use that to buy up a lot of assets when people have a weak currency, because, like in Jesse's example, when you're talking about shells, there were societies that used shells for money. And the reason it worked was because you had to find the shells underwater and they didn't have good boats. And, settlers, explorers came in and they said, oh, you guys are using shells for money. Terrific. And they had better boats. and they simply went further out from shore and were able to collect more shells. And by making their money soft, meaning easier to replicate, they were able to flood the system and acquire hard assets. And I think that's what Jesse was referring to. Jesse, do I have it right? Or, do you want
Yeah,
to clarify
yeah,
this?
that's right. And similar to that, a big part of the story in Africa was that back in Venice, they were good at making glass beads.
Right.
And it happened that many cultures in Africa landed on glass beads as a form of value, which was very hard to make with the methods that were available in Africa. But very easy for the Italians to send a boatload of glass beads down and then buy up all the wealth. I think with the Ramiro's question here of confiscation, confiscating wealth, I think of it more of like a osmotic flow of wealth from the various store value buckets that are out there into this new store value bucket, because of the osmotic pressure between the two, which is really driven by scarcity, I think. And so in the wealth confiscation scenario here, it's not so much actually about confiscating wealth from gold, but I think it is about how much money is sitting in sovereign debt that, given the macroeconomic climate, the fiscal position of the US and other G7 players, that debt is going to be negative real return negative real return investment over the coming decade or two, because of the scale of printing that's going to be necessary to service these debt burdens in an era where we now have 5% interest rates after a decade of 0% interest rates. And so there's $300 trillion sitting in global debt, and Bitcoin is a $500 billion asset class right now. And in my opinion, because of the feature of the increasing scarcity in Bitcoin that happens once every 4 years, it's baked into the protocol, into the code of the everybody's running on the Bitcoin network. Once every 4 years, we see a bull market because suddenly it's a more scarce asset. The supply demand price equilibrium gets upended. There's not as much new supply coming into the market to meet incoming demand, and so the price drifts upwards, turns into a little bubble, and we go through the whole song and dance every 4 years. And I think because of those properties, Bitcoin actually can serve as the, in my opinion, safe, in my opinion, reliable form of yield that historically sovereign debt has provided. And so it becomes a question of, for each individual at an individual level, looking at their portfolio and saying, do I want to own this much of a bond portfolio? And do I want to own this little of a Bitcoin portfolio? And do I need to rebalance? And so I think that's the story that plays out.
Yeah, I think the point you're making there is phenomenal, because if you are, like myself, a traditionally trained hedge fund manager, somebody accustomed to the equity markets, to the debt markets, it can become an allocation question. And so, I talk to people and they say to me, well, why? I don't understand. Why would I own Bitcoin? And my response is, why do you trust 100% of your assets in dollars, right? Take a 50 basis point, 0.5%, a 1% position, and, and have some exposure there, right? And that's we think in terms of exposure. Jesse, I have two really important issues I want to get to with you, but before we do, I'm going to take one last question on from the chat. Brooke asks a phenomenal question. He says, "What's to stop Bitcoin 2?" I'm going to take a crack at it and then get your answer, and then I want to move on to two key points. But Brooke, my answer to that is there is absolutely nothing to stop Bitcoin 2. If you wanted to set up that protocol and convince people to use it, you absolutely could do it. To me, the thing that I think is more interesting is there have been thousands and thousands and thousands of other crypto coins, experiments, but none of them adopt the characteristics that have made Bitcoin the apex cryptocurrency. The answer is there's nothing to stop it, except it's hard and you don't get to start with a giant pool, right? You can't have Bitcoin 2 and do what Ethereum did and have 70% of the supply in your pocket on day one. And I think that may be part of it. But the answer is you could do it. People aren't, because it's hard and you don't get to start with a giant lead. That's my answer. Jesse, what do you think?
Yeah, I summarize this with what I call the crypto catch-22, where to catch Bitcoin, you need a marketing budget because Bitcoin has this huge presence. So to catch Bitcoin, you need a marketing budget. But by having a marketing budget, you are no longer a decentralized, viable alternative to Bitcoin. You are now a company. So, it's impossible to catch up to this network effect by repeating the path dependent approach that Bitcoin took. So, 30,000 crypto projects have tried and they've all failed.
There you go. Okay. Jesse, last two questions for you, key issues. I'm just going to set the agenda for you. One, I want to talk to you a bit about Bitcoin ETFs. That's obviously a key thing in the news. It's something Deep Knowledge Investing subscribers are watching with me. We all have positions in GBTC, the Grayscale Bitcoin Trust, partly because we think the ETF will be approved. I want to ask you, I know you've got opinions on the BlackRock ETF as well. I want to get your view on that. And then after we resolve that, I'm going to get to the Bitcoin issue that I know is your passion and something I think is very important. I want to talk to you about self-custody and self-custody options and ways to do that safely and the issues people are running into, because I know you have some innovative solutions to that. So let's deal with the Bitcoin ETF first. And then we'll get to the stuff that I think, plays right into what you're doing at Onramp Bitcoin. So what are your thoughts? Is the SEC going to approve it? Are they going to drag this out? Who's going to be first approved? What do you think about Grayscale, BlackRock, Fidelity? Go.
Yeah. Welcome to our world, everybody.
Yeah.
That I think there's no reason for the ETFs to not be approved. The question is when, and I'm sure you all have noticed how there seems to be some major resistance to this that is not entirely transparent. The reasons for it are a little bit obscure or hidden, and that's welcome to crypto for how we've been experiencing regulators' views and opinions and slowness to establish clarity on what's allowed and not allowed in crypto. I think that I default to what the Bloomberg ETF pros are saying, and they're expecting it as, I think their current expectation is 75% chance of approval by the end of the year. I would not be surprised if it takes much longer. I basically at this point, following Bitcoin for this long, I don't count on anything until it has happened. And I think that's a prudent way to approach it. I think it's bound to happen at some point. There is some speculation that the actual reason for resistance is that Binance, a non-US, an offshore crypto exchange, may or may not be engaged in some price manipulation, and the SEC sure doesn't like that, and may not want to expose investors to that kind of market. So at the same time, they are taking action against Binance pretty aggressively, and so we'll see how that dust settles, and that could take some time, but it's an inevitable. It's just a question of when.
Yeah, I'm with you on that. All right, let's talk about self-custody. And for everybody listening to this, the reason self-custody is so important is because if you own your Bitcoin on an exchange, you think it's your Bitcoin. We're very much accustomed to, you get your bank account, you have money in your bank account, and you say, well, this is my money. Well, you know, the bank is holding it. And the issue with the Bitcoin exchanges is if you have your Bitcoin on an exchange, you are simply a creditor of a corporation that could go out of business, that sometimes does bad things, and they can use your Bitcoin to pay other liabilities. And that is the genesis of the phrase, not your keys, not your Bitcoin. Now, if any one of you listening to this has your Bitcoin on an exchange, I am begging you, do not wait today, this week, get it off the exchange, self-custody. Now that can be difficult for people. If you look at the chat, Deep Knowledge Investing has a guide to self-custody. It is really simple. I mean, I have laid it out for you as simple as press this button, put in an amount here, with pictures, red lines drawn to show you how to do it. It is scary the first time you do it, but the guide that Deep Knowledge Investing has out will walk you through it so that when you transfer any amount of real asset or real money, you'll be confident it will work. Now, Jesse, you're dealing with this at a completely different level. This isn't just, you know, buy a ledger device and store it, or get a software wallet or hardware wallet. What you guys are doing is much more advanced. I would love for people to understand it. Also, I'm going to put the plug in here. Jesse's company, Onramp Bitcoin, had their launch today. Congratulations. We are hoping for nothing but success for you guys. One, because I like you guys, but two, I think what you're doing is really important. But help people understand what is different and innovative and important about Onramp Bitcoin's solution, and because people should understand it and how this is being done at the high end.
Yeah, thank you. Yeah, so we launched all of our expanded product suite today. We've actually had a spot Bitcoin fund operating since the start of the year, January 1st, with the same sort of approach to custody here that we'll talk about. So to date in Bitcoin custody, you've had two options. You have self-custody or third-party custody. And so self-custody is you take control of your keys, you set up your security, your system for how you're going to store your Bitcoin. And what that means is, at the end of the day, is how you're keeping a very long text string completely safe. Right? That is your password to access your Bitcoin at the end of the day, an incredibly long text string that nobody can crack. But if it's compromised, anybody can take your Bitcoin. So that's the challenge with self-custody. There are great ways to do self-custody. Gary has gone down this path and figured it out, and it's doable. And if you're up for it, it is the best way to go, because you control it and you have set up outstanding security in that way. The other current method is third-party custody, where you're trusting your Bitcoin to Coinbase, or maybe it's to GBTC, where they're holding your Bitcoin on your behalf. But we've seen how that plays out. FTX was a third-party custodian of people's Bitcoin, and went under and left a lot of people thinking they had Bitcoin there, when in fact they had rehypothecated it, and they had paper Bitcoin claims on a company that now had no assets left. Prime Trust, Fortress Trust, recent examples this year of third-party custodians, qualified custody custodians who didn't really know what they were doing, and mismanaged their security, and lost coins for their clients. So those have been your options, and self-custody is excellent security, but it's hard to set up. And third-party custody, leaving it with Coinbase, is easy, but you don't get great security, mostly because you're trusting this black box, and you're trusting that a company won't rehypothecate your Bitcoin, when there's a long track record of companies doing exactly that. And in fact, with the BlackRock ETF and other ETFs, they could do that as well. They can lend out the assets in the ETF. And so at Onramp, what's been happening in the retail custody landscape for Bitcoin over the last half decade is the emergence of multi-sig custody, which is you set up a solution, an arrangement that where you have 3 different keys that control a single vault where your Bitcoin is held, and you need to sign any transaction with 2 out of the 3 of the keys in order to effect control on that Bitcoin. And that's an excellent innovation that has been proven out over the last 5 years, and has worked in the retail market. And now Onramp, the company that we've been building the last year, is taking that and institutionalizing it. We have set up multi-institution, multi-sig vaults in collaboration with the best Bitcoin custodians in the industry, where Onramp holds 1 key. BitGo, the industry leading infrastructure provider and founded by the inventor of Bitcoin's multi-sig properties, holds 1 key. And then you have a choice between the 3rd key agent, Kingdom Trust, a qualified custodian that was the first Bitcoin custodian, first qualified Bitcoin custodian, or CoinCover, a UK alternative to have jurisdictional distribution. And so those are the 3 entities that each hold a key controlling your Bitcoin vault. And the key there is that no single entity can effect control on those funds. There's no unilateral control of your Bitcoin sitting in your vault. You retain control of that, because in order to sign a transaction on your behalf, each of those parties has to go through an authentication process, their standard operating procedures, to verify with you that you want this transaction to be signed and the Bitcoin to be sent to this destination. And so, no single company can do that without your involvement and approval, and you have to do that for multiple signatures. So in this way, we've taken the advantages of third-party custody. It's easy. You don't have to set up self-custody. And we've combined that with the outstanding security of self-custody done with multi-sig vaults, this 203 arrangement. And now we have launched our suite of products built on this form of multi-institution custody. So we have a Bitcoin fund, if you want to have exposure to spot Bitcoin, rather than GBTC, where it's a paper claim on Bitcoin that they are hopefully not rehypothecating, but you never fully know. We have a spot Bitcoin fund where it's a grantor trust. It's your Bitcoin. It sits in a vault. You can see it. We have that product, as well as private wealth offering, wealth for RIAs. So if you're an RIA or know an RIA who is looking for a Bitcoin turnkey asset management platform, we have that. And then finally, if you have Bitcoin and you are either don't trust your current custody setup, or you're looking to diversify your custody setup, you can use our Onramp multi-institution custody setup and become a client of ours, and put your Bitcoin in a vault that's held, that's controlled by 3 different institutions, each holding a key, and no institution can control it without you.
All right. So for people who are interested in that, Jesse, how do they find you?
Yeah, you can find us at onrampbitcoin.com. And we're also on Twitter, and you can find me on Twitter as well. Jesse Myers, but my Twitter handle is Croesus_BTC. It's at CROESUS_BTC. I adopted a pen name a number of years ago in the Bitcoin space, and I've stuck with it.
It is a great handle going back to ancient Roman times. Just give people, how did you come up with it? What is it?
Yeah, that is a nod to history. It's a Greek king who played an important role in the history of money, because Croesus was the first king to come up with a bimetallic standardized coin system, which was, you had your gold coins and your silver coins, and the stamp of the king on that coin told you that it was a certain weightage, certain amount of gold in this coin. And that greatly reduced the friction involved in any commerce because you knew how much money you were being offered without having to get out your weights in scales and assay the quality of the metal.
Yeah, which by the way, everyone, that is why many coins today have ridges on the sides. It's to prevent people from shaving the coin down and making another coin out of it. You don't have to weigh it if the ridges are good. Anyway, Jesse, so great speaking with you. Good luck with the Onramp Bitcoin launch. Again, we want nothing but success for you. Everyone, thank you so much for tuning in. I'm Gary Brode from Deep Knowledge Investing, and we're excited to have had the chance to talk to Jesse Myers from Onramp Bitcoin today. Jesse, thank you.
Thanks for having me, Gary.